Let me ask you something that might change how you see everything you own. Do you own a home? Most people would say that's an asset. Do you drive a car? Most people would say that's an asset too. Maybe you have money in a savings account. Surely that's an asset. And if you went to university, you might consider that one of your biggest assets of all. What if I told you that most of those things are actually liabilities? Not because they're bad decisions, not because you did something wrong, but because the way most of us were taught to think about assets and liabilities is fundamentally backwards, and it's quietly keeping millions of people from building real wealth. Today, we're going to fix that. By the end of this video, you'll see your financial life completely differently, and you'll know exactly what to start building instead. Let's get into it. So what actually is an asset? And what's a liability? The traditional definition you might have learned in school goes something like this. An asset is something you own that has value. A liability is something you owe. Simple enough. But this definition is missing something critical. And that missing piece is what separates people who build wealth from people who just accumulate stuff. Robert Kiyosaki, in his landmark book, Rich Dad, Poor Dad, gave us a much more useful definition. And it's this: an asset puts money into your pocket. A liability takes money out. That's it. That's the whole framework. And once you apply it honestly to what you own, everything changes. The question isn't, does this thing have value? The question is, does this thing generate income for me, or does it cost me money every month? Let's run through 7 of the most common examples, and I think a few of these are going to surprise you. Number 1, your home. This is the big one, and I know this might be uncomfortable to hear. For most people, their home is a liability, not an asset. Here's why. Every single month, your home takes money out of your pocket. Mortgage payments, property taxes, insurance, maintenance, repairs, the roof that needs replacing, the boiler that breaks down in winter. Your home does not generate income for you. It costs you money, month after month, year after year. And here's the part nobody talks about at the dinner table. Most people finance that liability with the largest, longest loan of their entire lives. A 25 or 30-year mortgage. Think about how much interest you pay over those decades. The bank doesn't call your house a liability. For them, your mortgage is one of their best assets. They're collecting income from you month after month for 30 years. Now, does your home have value? Of course. Can it appreciate over time? Yes. But appreciation is not the same as cash flow. If your home isn't generating income, by our definition, it's a liability. A home only becomes an asset when it generates income. Like a rental property, where the rent covers the costs and leaves something over. That's when the definition changes. Number 2, your car. This one's even clearer. And this one makes me want to shake people by the shoulders a little bit. Most people will walk into a car dealership and willingly sign a contract, consciously knowing that the moment they drive that car off the lot, they've instantly lost 20% or more of its value, a guaranteed immediate loss. They accept that without hesitation. But it gets worse. Most of them don't even pay cash for that guaranteed loss. They take out a loan for it. So now they're paying interest, month after month, on something that's worth less every single day. The car is depreciating. The loan is accumulating interest. They're losing from both ends simultaneously. And yet, those same people are too scared to take that same money and invest it in the stock market, where historically, over the long term, it grows. Think about that for a second. A guaranteed loss financed with debt? No problem, sign me up. A chance at long-term growth? Too risky. That's not logic, that's emotion. And it's costing people a fortune. Buy cars with cash when possible. Drive them long after they're paid off. Never let a depreciating, interest-bearing liability masquerade as a symbol of success. Number 3, Your savings account. Now this one's more nuanced. A savings account technically generates income, interest, so it's an asset, right? Barely. Here's the problem. In most savings accounts, the interest rate is lower than inflation, which means in real terms, your money is actually losing purchasing power every year while it sits there. You have more numbers in your account, but those numbers buy less than they did before. A savings account is a necessary tool. You need it for your emergency fund, your liquidity, your peace of mind. But don't confuse it with wealth building. Money sitting in a low-interest account isn't working for you. It's slowly being eroded. Keep what you need liquid. But understand that a savings account alone will never build wealth. That requires assets that genuinely outpace inflation, which brings us to points 5, 6, and 7. Number 4, your degree or education. Education is one of the most debated topics in personal finance, and rightly so. But I want to make an important distinction here because this goes deeper than most people think. A formal degree can be an asset if it increases your earning power enough to justify the cost. A medical degree, an engineering qualification, a law degree, these can generate significant returns over a lifetime. But a degree that costs a fortune and leads to a career with limited earning growth, that's a liability you'll carry for years. But here's what really fires me up. The most valuable financial education you'll ever get is almost certainly not something you learned in school. Think about it. When did any teacher sit you down and explain how compound interest works, how to read a balance sheet, how taxes actually function, and how to legally minimize them, how money makes money? They didn't, because schools aren't designed to teach you that. The most powerful investment you can make is in your own financial literacy and mindset. Books, podcasts, mentors, courses, learning how to manage your own finances, understanding how wealth actually gets built, developing the mindset to think long-term. This is an asset that pays you back for the rest of your life, and it costs a fraction of a university degree. Never stop learning, but be intentional about what you learn. Invest in knowledge that directly increases your earning power or your ability to manage and grow what you earn. Number 5, a rental property. Now we're into real asset territory. A rental property, one where the rent received exceeds the mortgage, taxes, insurance, and maintenance, puts money in your pocket every month. It generates income while you sleep. It can appreciate in value over time. And unlike your own home, it's someone else paying down your costs. This is why real estate has been one of the most reliable paths to wealth throughout history. Not because property always goes up, it doesn't always, but because a well-chosen rental property is a genuine income-producing asset. The goal is to own property. The goal is to own property that works for you financially, month after month, whether you're paying attention or not. Number 6, stocks and index funds. If you invest in stocks, particularly low-cost index funds, you own a small piece of hundreds or thousands of companies. Those companies generate profits. Some pay dividends. All of them, historically over long periods, have grown in value. This is a true asset. It generates returns. It compounds over time. And unlike property, it requires almost no active management, and you can start with almost any amount. Remember what we said about the car? The person who financed a depreciating vehicle instead of investing that money? This is where that money could have gone instead. You don't need to be a stock-picking genius. A simple, consistent investment into a broad index fund, started early and left alone, is one of the most powerful wealth-building tools available to ordinary people, bar none. Number 7, a business that runs without you. This is the ultimate asset, and the one most people never build. Robert Kiyosaki has another book that I'd argue is even more life-changing than Rich Dad, Poor Dad. It's called The Cash Flow Quadrant, and it maps out 4 ways people earn money: as an employee, as self-employed, as a business owner, or as an investor. Most people spend their entire lives on the left side of that quadrant, trading their time for money as an employee or a self-employed person. The moment they stop working, the income stops. The right side of the quadrant is where wealth actually lives. Business owners who have systems and people working for them. Investors whose money generates returns without their daily involvement. A business that depends entirely on your time and presence is not an asset. It's a job you own. But a business that generates income whether you're there or not, that's an asset. A YouTube channel that earns ad revenue. A digital product that sells while you sleep. A rental portfolio managed by an agent. A system that delivers value without requiring your constant input. This is what the wealthiest people in the world understand that most people don't. They don't trade time for money. They build things that generate money on their own. Start asking yourself, what can I build, create, or own that will continue to generate value even when I'm not actively working? That question is worth more than any degree. So let's bring it together. Assets put money in your pocket. Liabilities take money out. Your home, your car, your savings account, and even your formal education, in their standard form, are liabilities or marginal assets at best. Rental income, index funds, and income-producing businesses, these are the real assets that build wealth over time. This doesn't mean you shouldn't own a home or drive a car or get a degree. It means you should see these things clearly for what they are and make intentional choices about where your real asset-building energy goes. I want to leave you with this. The wealthy don't just accumulate things, they build things that pay them. And it all starts with knowing the difference between what looks like an asset and what actually is one. If this gave you a new way to look at your finances, hit that like button. It genuinely helps more people find this video. Drop a comment and tell me, which one of these surprised you most? I read everyone. If you're new here, subscribe and tap the bell, because next week, we're going deep on the multiple account system. Thanks for watching. I'll see you in the next one.